Hello friends, welcome back to my channel Finance Unpacked with SB. In continuation with our previous series where we discussed about the repo and reverse repo rate transactions and also the reasons why there was a delay in transferring of these rate cuts to customers, today I want to discuss an article with you which was published in Economic Times on April 15th. It says that SBI had cut its lending rate by 25 basis point and also the deposits rate by 20 basis point. Now this happened on April 15th, which is after the April 9th MPC meeting where the RBI has reduced the repo rate by 25 basis point. A noteworthy point is that in April 2023, SBI introduced a 444 days term FD, which is equivalent to 1 year 2 month FD, and the rate that was offered at that time was 7.25%. Now what was happening, let me give you a background about it. As we have discussed in our last series, in our last video, that CASA and term deposits constitute the major portion of sources of funds for the bank. But what was happening is people were not depositing their extra money in their bank accounts, or they were not creating FDs. Instead, their money was diverted to other investment options like stock markets, derivatives market, etc. So in order to make the bank deposits more attractive for the customers, what SBI did was they offered a new term period FD, which was 444 days, and the rate of interest that was offered was 7.25%. But after the MPC meeting where the RBI has cut the repo rate by 25 basis point, the SBI has also reduced its rate on such term FDs and many other FDs for different tenures by 25 basis point. Also, it is noteworthy that though the external linked rate has been reduced by 25 basis point and they have been reduced to the loan rate have been reduced to almost 8.20% after deduction, 8% after deduction, but the MCLR rate, the marginal cost of lending rate, which we discussed in the last video, which is like the rate at which the banks are getting the funds from the CASA, from term deposits, from repo, for other banks, etc., is still high. And as we have discussed that it will take at least 2 quarters for the results of the repo rate cut to flow into the MPC rates. Therefore, the MCLR rate is still above 8.2 to 8.30%, whereas the external benchmark linked rates have been reduced to 8%. I hope this series has helped you in understanding how the repo rate cuts affect your loan and deposit rate of interest and make you an informed investor. Thank you.